Commodities are surging again. Is this the next round of the inflation monster? You came here for the truth, so let me unveil that for you. Today we are going to look at what's been happening with the inflation madness. It's been going on all over the place. You've seen used cars, you've seen houses, you've seen just about everything going up. We're going to talk more about that and give you the insight what's going on right now. We also have to talk about the jobs because there is some huge disparity taking place today. And of course, last but not least, we need to discuss the economy. The economic factors that are in place today are all over the place. And I want to put that into this right now. I want to talk about it and outline what you need to know. Let's begin. Let's start with what's going on with the Federal Reserve. Of course, we're talking about inflation. Got to talk about the Fed. The balance sheet is now at $8.1 trillion. They're talking about taper or talking about taper. And yet, take a look at this. So much for all the taper talk. The Fed just added the largest amount of assets to its balance sheet in over a year. That is $200 billion in the last 4 weeks. It's unbelievable to see the lengths that this institution has gone to. Unbelievable. Powell inflation view backed by Fed majority in rate debate. Is that surprising to anybody? I mean, sure, you could see that what's going on all over the place is simply, the dot plot, they're trying to make this seem like it's something because they want the news articles to really show you that, there's all this activity happening and what's going to, the uncertainty. Oh my goodness. We know what's going to happen. The Fed's going to print a bunch of money. And you know that interest rates are, even if they do increase, they are still historically very, very low. When the Federal Reserve decides to dry up the liquidity, that's on them to decide. They're not going to look at any specific statistic. As far as I'm concerned, that's the way this is all played out. Look at this. Key inflation indicator posts biggest year-over-year gain in nearly 3 decades. And what are we talking about here? The Fed's favorite indicator, and that is the core PCE rate. Right now, rose 3.4% from a year ago. It was the biggest increase since 1992. Now, you have to take this into account when you're talking about timing-wise. I mean, from a year ago, anything looks really high because of how low things were. There was such a collapse in many different indicators. So you do have growth there. However, they are not clearly looking at the core PCE rate right now. It can go to up to 10, even on this heavily manipulated statistic, because they do not care. This is the chart that corresponds to that information. You could see going back all the way to the 90s. And this just gives us an idea of where this particular measure of inflation, which it's not a measure of real inflation, but that's besides the point. U.S. consumer spending paused in May as shortages hurt motor vehicle purchases, but the supply constraints and increased demand for services helped to lift prices. And this is what you need to understand, is that when you look at any of these measures, for example, GDP, I think I just covered in the previous video, you got to understand when Obamacare was first introduced, the GDP was 5% growth. But why? It's because suddenly people needed to spend more money on their healthcare. That's why things happen. You need to dig down a step deeper. You need to go in and you need to peel back the layers of the onion, whatever kind of analogy you want to use. All of that needs to be understood so that this inflation gauge isn't just a number, but it actually has context. Okay, a couple charts here, and then I want to go look at the GPS insights. This is the personal spending. You could see right here, personal spending unchanged in May 2021. You could see it over the past year. It's been up, it's been down. And why? Because it's all related to what happens with the stimulus. Look at the consumer sentiment. In general, yes, it's up and down, but in general, it has been moving up. People are getting their jobs. They are getting the stimulus. Those who are already had jobs previously and it was sort of status quo this entire period, well, their 401k, their retirement account, whatever it might be, is doing better. So they're spending as much as they can. But look at it always a step deeper. This is something that I want to touch on here briefly, and we'll cover it more in a moment. A measure of fear in stocks is breaking out to the downside, set to unleash a wave of buying power from hedge funds and other algorithmic traders to push stocks higher. We're talking about the VIX, okay? So I want to look at that and understand what happens with the VIX. This is just for your information, it's a very manipulated gauge, but this is something that traders are using on a daily basis. So when the VIX is going down, that's basically a sign to buy. It's a bullish indicator when the VIX is moving down. That's why you saw all throughout 2017, VIX was sliding down further and further, and the stock market kept going up month after month after month. These are correlated in their own manipulated way. And now for the Money GPS insights. Number one, it's very clear at this point, but you can see that inflation and price inflation specifically is rising faster than wages. And this goes in particular for those in the bottom 80%. Number two, this is forcing people to become investors, but they don't have the knowledge. And number three, the Fed has created these asset bubbles and has pulled in Main Street. That right there is some very key information. I wanted to take the time right now really quickly to tell you that if you want to get in touch with me and for me to get in touch with you, this is the way to do it, and that is the insiders. 5 times a week, I email you the video of the day that gets around their system. Their system is obviously censoring us. It's obviously taking down the information so I can get to you directly, okay? We got thousands of people on this already, thousands more. I need you guys to get on here. It's free. It's completely free, of course. It's themoneygps.com. You go there, you sign up. That's going to get me to email you on a daily basis. You're just going to get that. And in a very short period of time, this is going to contain original content as well. I'm doing original content on Instagram and Twitter and Facebook and every platform. Search for The Money GPS. You will see me there. I'm now outputting things onto all different places, alternative and mainstream, because I need to get to you and I need to pull more and more people in, okay? This is so important that this information gets to the people who need it. I'm going even a step further. In the coming days and the coming weeks, I am taking on sponsors. I'm going to turn the ads off. Yes, I understand that this platform here, I'm not allowed to name, this platform does put the ads on some videos, even if you take the ads off, but it's very rare. It's seldom. The point is I'm taking ads off so that I don't have to rely on their revenue for this business. I'm taking matters into my own hands. I'm finding good companies to work with, and it's going to be fantastic. You're going to see this in the coming days, the coming weeks. I hope you support me on this. I really appreciate it. Let's move on, okay? Scott Minerd, who's from Guggenheim Investments, he has basically suggested that Bitcoin has not hit a bottom yet. This is a guy, and this is a company that have said right here, it shows it, that Bitcoin hits $400,000 at some point in the future. So he's bullish on it. They are bullish on it. And yet he's saying this is not the bottom yet. 30,000, around that $33,000 range, as I have covered previously. I mean, I could show you right here really quickly. You could see Bitcoin, I mean, time and time again. These are daily candles, by the way. You just see it right around that $33,000 mark. Right now it is sitting at 32,000 as I record this. I also wanted to touch on this, the bank stocks. If you can see this, if you remember in the previous video, I told you, check the bank stocks. Look at what happened. Green candles. And you're seeing that right now. The number one reason, as I covered in the previous video, was because of what the Federal Reserve did. They're going to lift this cap and they're going to be allowed to extend to the shareholders dividends and share buybacks and so on. So it's going to push the prices up, and the VIX, of course, getting pushed down further and further. I mean, is this thing ever up? Anyway, there's much more that I would love to cover on the technicals as well. But hey, I'm trying to do what I can. Used car prices right now apparently are poised to peak in the US after a huge surge. So the prices have gone up. I mean, you don't find something like this to be considered an asset, but a used car being an asset, 20% year over year. Never seen anything like that before. Asset inflation, commodity inflation, and housing inflation. This is the house price index on a log scale, US, UK, Australia, New Zealand, and Canada. And you could see what happens here. Now, if we were to look at, for instance, US specifically, you would see a much bigger drop in 2007. But the point is this, that we are potentially, around this point in time where the prices are in that acceleration mode, where it peaks out. I don't know, certainly, but there's a lot of factors around that right now. Look at the commodity index. Okay, so this is right now the 6 month. If I show you the 1 month, I hope, yes, right there. So you could see that it bottomed out on June 17th, and since then it's been rallying. So keep a close eye on this, because there are a lot of things that are related to this. And I do have a few more things to touch on really quickly if I have the time. This is one of them. Corporations no longer share the wealth. I think we knew that. But this is just something that, as you can see right here, corporate profits after tax, that's the blue shaded area. And certainly there's a lot of profit coming through for these companies. And yet, orange line, wages to profits ratio, it's been down. It's been down, of course. Now, real investment advice, put this out here. If you have the time, check out this article. As always, this is one of my favorite resources. Share buybacks are the problem. And it's basically just getting into the fact that what these, the way that these companies work is that, as they say here right now, the SEC found many corporate executives sell significant amounts of their shares after the companies announced stock buybacks. It's an absolute fact, and the SEC even admits it. Now, there's nothing wrong with that according to them, so that's why they do this. And the stats are there. The data is there. Share buybacks are not there to help you. Share buybacks are there to have those insiders who are relying on those to come, basically to fund their lifestyle. They might take a simple salary. I think Bezos takes an $80,000 salary. Why? Because his wealth is made from the shares, okay? The shares in what they own. This article here is just talking about the bars, the restaurants, and so on. I just want to show you something here. Restaurant and bar employment remains down by 1.5 million since the beginning of 2020. By contrast, warehousing and storage jobs are up by 81,000. More businesses are going this route. It's not just Amazon, but Amazon has hired hundreds of thousands of people since last year. It's been unbelievable to see where the jobs are shifting, okay? And at the same time, we are looking at Instacart, I think it was, that wants to completely change the way that you get your groceries. Big time changes coming. This was just an article about Bank of America, nice little slap on the wrist for them, and tax increases coming to San Francisco. There's always too much data to cover. If you found the video informative, hit that thumbs up button. I really appreciate that. And if you haven't seen this video already, you definitely want to check it out. It's right here. Click it and I'll see you there.